Hello guys, you're welcome to my channel, and in today's episode we'll be looking at market structure. Over the course of trading, market structure has always been a problem with traders. When we all started off in our trading journey, we were all familiarized with this kind of move, that this is how the market works, this is how the market moves. But in reality, you won't see a clear movement like this in the market. Rather, what the market gives to us is something like this. This is what the market gives to us. We will have something like this, a wave-like form. So it is our ability to correlate this and this. That is what will give us the winning edge in our trading. A lot of people have asked this question so many times, that which is key? Is it the entry? Is it the exits? Is it the analysis? Or is it the indicators you use in trading? And I keep telling them that market structure is key, because market structure tells you a lot. It tells you the direction of where trade is going. It helps you to know where you take your trade from. It also helps you to know where you put your take profit and your stop losses. And it also helps you to know when to break even on a trade. You don't just break even like that. You need to know exactly when to do this and how to do it. Because if you're on a trade, sometimes you might be in a trade going up. You're looking at targeting somewhere here, and your trade might be going up, and the next minute, almost close to your take profits, and then what happens? It changes direction, and then it goes against you. So most of the times we encounter this problem in our trade, where trade almost hits our take profit, and the next thing you know, it has reverted back, it has reversed, and it's going against us. Now, with the knowledge of with the knowledge of market structure, you will know from your analysis, from your understanding of price of a market structure, you know when the trend has changed direction, and then you do what? You exit, or you can as well break even. It is the knowledge of price of a market structure that gives us this idea. Oh, something has happened. Trend has changed direction. Let me exit. Or trend is still in the right direction, because market structure tells us a lot. It tells us the whole story about what is going on in our chart. It is not the candlesticks or the indicators or the charts that tells us. It is the market structure that tells us the full story of what is going on currently. If we are buying, market structure tells us. If we are selling, market structure also tells us. If we are in a range phase, market structure also tells us. Basically, we have three types of movement in the market. We have our bullish run, which happens to be our buying trend, or can say an uptrend. We also have our selling phase, which is our bearish phase, which is same as our downtrend. And then we have the consolidated phase, which is also the same thing as the ranging phase of it, where market is not going up, it's neither going down. In this run, we tend to be making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. While on the downtrend of it, we tend to be making lower low, lower highs, lower low, lower highs. While on the ranging phase, we are only making highs and lows, highs and lows. That is what it is. Now, there are how we look at the markets. A lot of people have problems with market structure. And when you start having problems with market structure, it becomes difficult for you to really understand what is going on in the market. The market is not going to give you that clear cut, that clear charts that we all wish to see, something like this. Everybody wants to see this on your chart, but this is not what the market is going to give you. The market will give you something like this. Look how zigzag it is. This is what price will give you, and not something like this. Price is not going to give you something like this for you to quickly understand. So it is your ability to understand market structure that will aid you to know, am I in an uptrend or am I in a downtrend? Has the trend exhausted? And so on and so forth. Now, there is no way we can talk about market structure without we talking about the Elliott wave. You know, most traders overlook that concept. Most people they don't really focus on it. Most people don't even consider it as something to acknowledge. But there is no way you can talk about market structure without the Elliott wave. The Elliott wave is the market structure. Your Elliott wave is your market structure. And also, we have two types of Elliott wave. Throughout my years of trading and my experience in trading, I have encountered two types of Elliott wave. And those types of Elliott wave are in this form. We have this high, we have this low. We have the next push taking out this high. Then we'll have the next low creating another high. And then we'll have this push taking out this high. Taking out that high there. Now, this will be something like this, where we have this push to be big. We have this push also to be big. And then we'll have this to be small. I repeat, we'll have this impulsive leg here to be big, this impulsive leg here to be big, and then this impulsive leg here to be small. Lest I forget, the Elliott wave comprises of 3 impulsive leg and 2 corrective leg. Before we go further, let's really understand it well. We have 3 impulsive leg 1, correction leg 1, impulsive leg 2, correction leg 2, impulsive leg 3. Now, impulsive leg 1 needs to be big. Impulsive leg 2 needs to be big also. But impulsive leg 3 needs to be small. When this impulsive leg becomes small, it speaks a lot of things. It indicates a lot of things. One of the things it indicates is price has lost the steam, the momentum, the pressure of going up. I repeat, impulsive leg 1 will be big. Impulsive leg 2 will be big also. and then impulsive leg 3 will be small. When you see this impulsive leg becoming small, it indicates two things. One, price is going for, most likely, price is going into what? Ranging phase before continue going up. Or price is going into a new different direction. When you have impulsive leg 1 big, impulsive leg 2 big also, and then impulsive leg 3 small, what it tells us is two things. Is either price is going into consolidation before continue going in the direction which it was going before, or price is about to change direction entirely. This is what it implies when you have this third impulsive leg to be small. And there is a pattern on how we do count our Elliott wave. Remember, we have 3 impulsive leg and 2 correction phase. We have 3 impulsive leg and 2 correction phase. How we count our Elliott wave is this. The beginning is always 0. The first high is 1. The first low is 2. The second high is 3. The second low here is 4. And then the third high is 5. This is how we count our Elliott wave. 0, 1, 2, 3, 4, 5. Now, as we proceed in this sequence of teaching, I will be doing an in-depth and understanding about this Elliott wave, how it relates to our market structure. Now, number 4, point number 4 is very, very crucial in our market structure. Point number 4 is very, very crucial when it comes to our market structure. 0 to 1 is expected to be big. 2 to 3 is expected to be big. Or the impulsive move here ought to be very long. Same here also. This is indicating that buyers are in full control. Buyers are also in full control here. But when 4 to 5 becomes small, it indicates that the buying pressure is low. Many buyers are leaving. The buying interest is low. Now, 2 things is likely to happen here. Like I said previously, is either price is going to range and then continue going up, or price is going to change direction and start selling automatic. Now, the 2 scenarios that happens here has number 4 as a key area. Number 4 is regarded as the key area. Why? Because number 4 is regarded as our inducement. Number 4 is regarded as our inducement. Number 4 is the inducement. Now, if number 4 is seen as the inducement, it implies is if this price want to continue going up, then this inducement need to be swept off. And then price will come down to point number 2. Price will go below point number 4 and then come within point number 2. And then do what? Pick up orders and then continue going up. At no time will price come down to point number 0. If this is an uptrend, in order for price to continue that uptrend momentum, price will never come down to point number 0. So when you're trading and then you find out that I'm in a bullish run, if we are in a bullish run, we want to take our trade, we want to buy up. Let's assume that we met this, we didn't meet price here. We didn't meet price here. We didn't. We also didn't meet price here. We met price at 4 to 5. This is where we met price. We met price at 4 to 5. 0.4 to 5. That was where we met this particular chart. And then from our analysis, we know that price is in an uptrend and we want to see price continue going up. The first thing we do, we calculate, we have to analyze, find with our Elliott wave where we are currently in that chart. It is the Elliott wave that will tell you where you are currently. Are you on the first swing? Are you on the second swing? Or are you on the third swing? Remember, the third swing is always small. The third swing is always small. Now, if we find ourselves not on the first swing, not on the second swing, but on the third swing, now, if we want to continue buying up, we are not going to start buying from this third swing. We have to exercise patience, be patient, because trading is more weight than action. So we are on 4 to 5. We need to exercise patience. We need to exercise patience. Allow price to come down and take out point number 4. Have it at the back of your mind that for this uptrend to be maintained, price cannot come down to point number 0. So always look for your entry on point number 2. I repeat, if this price wants to continue going up, it can never, I repeat, it will never come down to point number 0. Point number 2 is always your entry. That is why the Elliott wave made us to understand that we have the deep retracement and then we'll have the non-deep retracement. Mainly the deep retracement takes place between 50% of that swing. So from this top to this place, number 2 falls within that 50% area. So what we'll do in this instance that with the knowledge of our Elliott wave, we are not expecting this price to come down. So while others will be placing their key areas on this point 0, we are putting our key areas on point 2 because we know that for us to maintain this uptrend, price cannot come down to point 0, but rather price will come within point 2. So what do? We expect price to drop between this area and then we look for buy up to maintain our uptrend. That is when we are looking to continue buying up. But what about in an event we change direction? Let's say price has changed direction totally. Will point number 4 still be active? That is the question now. How do we use point number 4 to our advantage? Now, this is point number 4. For us to look for sell, we still do the same thing. Wait for price to go below point number 4. Now, if we are looking to buy, to sell, wait. Price is going to do this. Break another point number 4, come up, come within this area, pick up orders, and then you see price start doing what? Dropping. So point number 4 is key for price continuation. Point number 4 is also key for what? Price reversal. I repeat, point number 4 is key for price continuation, and point number 4 is also key for price reversal. This is one type of the Elliott wave. How does the other type of Elliott wave looks like? We have this big push, retracement, big push, retracement, and then we'll have this failed high. And then you see price start coming down. It's still the same thing, where we'll have this as 0. We'll have this here as 1. We have this here as 2. We have this here as 3. We have this here as 4. And then we have this here as what? 5. It's still the same thing all over. What it means is the buying pressure here is much to give us this long impulsive move. 2 to 3 also gives the same story that the buying pressure here is much. That is why price was able to go above this high here. But 4 to 5 is telling us that buyers have left. The buyers they are all gone. Now, price was unable to go above this high. The buying pressure has been extinguished, and it's now unable to go above this high. So what do? We still look at point number 4. Point number 4 is still key. Point number 4 is still what? Key. If I'm looking to buy this market up, I want to maintain my structure going up. What it means is I am now going to take this area here as my low, take here as my high, and not here. I'm going to take here as my low, take here as my high, and then not this 5. 5 is not going to be the high anymore. Rather, 3 will be the high. 4 will now be my inducement. So what I will be expecting price to do, I'll be expecting price to do this. Come down, sweep this man off, sweep this 4. After sweeping this 4, I'll be looking at this 2 as my point of interest. That is, if I'm to maintain price going up, in that case, I know price will not get to 0.0. To maintain that uptrend, I will look at buy at point number 2, while I will take point number 4 as my inducement, just like in the previous analysis. So what happened when price comes into my point of interest? Here is where I will look for price continue going up. Then this now becomes 0, 1, 2, 3. This now becomes 4, and this now becomes 5. So I'm going to shift this one off, take this one off. So this is how the structure will now look like. That is if I am buying up. But in an event whereby I'm selling down, I want to sell. Right. This is point number 4 here. And then this is point number 5 here. All right, so I want to sell. If I want to sell, I still look at point number 4. Until price goes below point number 4, then I will know that we are done with the uptrend. Then I should be looking to sell down. Here is my point number 5. So I should be expecting price to drop within this area, pick up the main orders, and then I drop it down. This is how we look at it. So these are the two variations of the Elliott wave as regard to our market structure. It's the same. When we are selling down, we have this move, and we have this impulsive leg, corrective leg, another impulsive leg, another corrective leg, and then another impulsive leg here. In this case, we have this to be long, we'll have this here to be long, and then we'll have this here to be what? Short. You can as well count it also. It's the same thing all over again. This becomes 0. This here becomes 1. This here becomes 2. This here becomes 3. And then this here becomes what? 4. And then finally, we'll have here as what? 5. We still look at point number 4. Point number 4 is our key area. Point number 4 is our key area. Now, if I want to continue selling, I want to sell, I'll wait for price to go above point number 4. Remember, point number 4 is our inducement. So the moment price goes above point number 4, then I'm not expecting price to come back to point 0. I'm expecting price to get between point 2 for me to maintain going down. I'm not expecting price to come back here. No, I'll be looking at price within point 2. So when I have this move, point 2 becomes my point of interest, then I look for my sell within that area going down to continue that downtrend. So that is when I'm going to change this, change this, change this. So this becomes 0, this becomes 1, this becomes 2, this becomes 3, then this becomes 4, and then this becomes 5. We extend it down. That is when we want to still continue going down. Here, originally was our 3 previously, remember that. Here was our 4, and then here is where we have our 5. Remember that. Here is where we have our 0.5. So we work based on this. So the Elliott wave is key because the Elliott wave tells us a whole lot of how the market operates. Tells us a whole lot of how the market operates. It is the Elliott wave that is the market structure. The Elliott wave is the market structure. The same goes here also. If I have this move like this, I have this correction, impulsive, correction, and then this one failed to go below. This low was broken quite well. This is 0. This is 1. This is 2. This is 3. And then this is 4. Point number 4 is key. It's always what? Key. If I want to buy up, I will wait until when point number 4 is taken off completely. When point number 4 is taken off completely, in case you don't understand it, this is 0. This is 1, 2, 3, 4, 5. So we exercise patience until point number 4 is taken off clearly. Once point number 4 is out, then wait for price to come within this area and then pick up orders. This is where we look for our buy up. So it's the same idea, is the same philosophy, is the same technique. You need to understand your Elliott wave well, because without the full understanding of your Elliott wave, you will be having problems when you come to chart like this. Where is the high? Where is your low? Where is your high? Which of the high are we looking at? So this is where we keep having those issues. You just need to understand it. This is your 0, this is your 1, this is your 2, this is your 3, this is your 4, this is your 5. You understand? So they are just there. The Elliott wave is there at all time, is there. But we tend not to really understand how it works. That has always been the problem with trading. We tend not to understand how it works. But when we understand it, it makes our job very easy to trade. This is 0. You get, this is 1, this is 2, this is 3, this is 4, this is 5. It's always there. I mean, it is always there, always there. This is 0. This here is 0. Here is 1. Here is 2. Here is 3. Here is 4. Here is 5. So it is always there in our chart. You see it there at all time. It's there. It's there. This is 0. This is 1. This is 2. This is 3. This is 4. And then this is 5. It's always there in our chart. Your inability to get it, I repeat, 0, 1, 2, 3, 4, 5. It's always there. So it is your ability to understand where is this Elliott wave? Where? How can you see it? That will help. It will help to give us a clear idea which area we are in our charts. Mind you, I said before, the fifth leg, 4 to 5, is always small. When it's small, it's an indication that that price has lost steam. Price is not going further. This is 0. This is 1. This is 2. 2 here. This is 3. This is 4. This is 5. You see it? It's there. It's there. We can now go the same with this too. This is 0. This is 1. This is 2. This here is 3. This here is 4. And then this here is 5. It's still there. No matter how we look at it from each angle, it's still there. The same thing goes with our current price now. This is 0. This is 1. This is 2. Hopefully, we are about to get 3. We will soon get 4. And then we will get 5. So this is how we map out areas. You know the exact area where you are in your chart. If you don't have the knowledge about your Elliott wave, you keep having problem to know when price is about to change or when price has changed direction. So it's always there. You can check virtually all the charts. All is there. Is there. So we just have to learn it. This again is 0. This is 1. This is 2. This is 3. This here is 4. And this here is 5. So it's always there. Once it gets to point number 5, then you know price is about to change direction. So until next time we meet, we'll exploit this more, and then we'll definitely have a full understanding. By then, we'll be diving into the chart. We'll see how we can relate it, and then see how we can break it down. Because this teaching is a sequence. This is just the beginning. In my next video, I will still go deep into it. And then we'll be dropping to lower time frames. So we see how we can take those entries at the key time for us to take those entries, at the important time for us to take those entries. All right. So have a nice day, everyone. See you in the next video.